Okay, so today what we're going to be working on here is the Chapter 5 homework assignment. So here in Chapter 5, the big topic that we'll be dealing with really has everything to do with how we account for inventory. So up until this point, we've seen inventory, right? We got really introduced to it with a bit of a discussion in Chapter 4. But here in Chapter 5, we'll actually be dealing with some inventory-specific issues and exactly how companies handle all of those items that may relate to inventory. So in this case, we see initially we have Homestead Crafts. They're a distributor of handmade gifts, and they operate out of their owner's house. At the end of the current period, she looks over her inventory and finds the following, right? So we need to essentially figure out, well, how do we handle these items? And specifically, why do we handle these items in the way that we do? So let's take them one at a time and we'll kind of walk through it. So in this first one, we see that we have 900 units or products in her basement. Notice 20 of which were damaged by water and cannot be sold. So basically the way they're going to set this up for you is they're going to start with initially the full 900 units. Then you'll notice down here toward the bottom, we subtract out those damaged units. So what we're saying is, I don't really have 900 units if 20 of those can't be sold. Because remember, back from Chapter 1, we're trying to provide useful information to decision makers, right? Not only those inside the company, but specifically those external to the organization. So what that tells me is it would not be correct for me to actually come in here and be counting stuff that I know I cannot sell, right? If it's been damaged and it cannot be fixed, it should not be counted. And so we actually do take that out here. Now, the next thing that we see is we have 110 units in her van ready to deliver to a customer. Notice the terms on this order, though, FOB destination. So we actually first saw this FOB destination piece back in Chapter 4 when we talked about FOB destination versus FOB shipping point. And what we found was that in this case, we are the seller. So with FOB destination, this remains the property of the seller until delivered. And that's what we said before, right? So when this is FOB destination, we had to notice the key word here, which was destination, right? So this right here is telling me when that ownership will change hands. So on the other hand, if I were to look at this as FOB shipping point, right, like we saw before, then we would say, well, FOB shipping point from the seller's perspective would mean that as soon as this was shipped and ready to go, that this is no longer their property. So what this tells me is that this would be the property or become the property of the buyer when shipped. Right, and so that's what we would see in that case. So very good. So that's essentially what is happening here. We're being kind of reminded of the shipping terms that we first saw back in Chapter 4. And remember, then I told you it would be very important that you remembered those. And that's because, at least in this chapter, also in Chapter 5, where we deal a lot with inventory, we're certainly going to be seeing those terms popping up a few more times. So in this case, we have FOB destination. So this remains the property of the seller until delivered. And if this is in her van, in her driveway, presumably, it hasn't arrived at the destination. So those units are considered units in transit. And because of the shipping terms, notice, right? Because of the shipping terms, those units remain counted in her inventory. And then finally, we see here, we have 140 units out on consignment to a friend who owns a retail store. So if you watched the lecture video, I went over consignment and who the parties are to a consignment transaction and how all that works in a lot of detail. I'm not going to do that again here. Certainly, if you have a question on it, feel free to come to class, ask me that question, shoot me an email. We'll work on it through that. But basically what's happening here is the consigned goods belong to whoever actually owns the goods. So whenever you deal with a consignment issue, you first ask the question, well, whose goods are these? And that's whose balance sheet they actually show up on. So in this case, we own these goods, presumably. They have been sent out to a friend who owns the store that's trying to sell them for us. So those are also included on our balance sheet in our inventory account. So then we simply add up 900 plus 110 is 1010 plus 140 is 1150 minus 20 is 1130. And that's how they're getting the 1,130 units here for the total units in inventory. Now, for the second problem that we've got, And let me just scroll down a little bit. So for the second problem that we've got, we see that a car dealer acquires a used car for $20,000. Notice the terms, all right? Always very important. FOB shipping point. So who's paying the shipping, right? If this changed hands at the shipping point, it is no longer the property of the seller. It is now the property of the buyer. And if it belongs to the buyer must pay shipping. So in this case, we see that we acquired the car for $20,000. That's the initial cost. But the question is to compute the total inventory cost assigned to the car. So what we have to realize is that the actual cost isn't just the actual invoice price that we see here. Remember, the cost of an asset is not only the initial cost, it also includes some other things. So the cost of an asset includes, right? We've got the invoice cost. We've got any additional costs necessary to procure the item and make it ready for its intended use. All of this, right? So one here, two here, right? Both of those are things that will be included in the cost of the actual asset. So you do have to be a little bit careful and make sure you don't get tripped up and think, oh, okay, well, we paid $20,000 for this asset. I bet I just record this for $20,000. That would not be correct, right? That would not be correct. So don't make that mistake, because then you would be forgetting all these extra things. So now we'll go through and talk about them. So the first thing, transportation in. Notice shipping point, buyer pays shipping. That's what this transportation in is. That is the cost that we paid to actually receive the car. Well, if I'm not able to sell the car, if I don't have the car, then this transportation in is certainly a cost that must be incurred to get this thing here and ready for its intended use. So we do see that cost being included in inventory. Next, we see our shipping insurance, right? Just like the other piece, this protects us in case that transportation vehicle were to fall off a cliff, right? And our car was to get burned up or destroyed, then we would still be covered for that. So it's certainly something that we do want. It is certainly something that helps us out. And so that is certainly part of this cost. So that pulls in right here. Next, we see that we've got some car import duties. If you want to think of this as just taxes, that's fine. That's really what an import duty is. It's just a kind of a fancy way of saying it. It's a specific type of tax. But what we see here is that $710, if I don't pay that, I don't get the car. So that is also going to be included in the actual cost of my inventory. Now, you'll notice these next three, they are not actually related to the receipt of the vehicle, right? Advertising, well, that's going to be what we call a selling expense, right? Like we saw back in chapter 4. So this advertising cost, that's going to be excluded from the cost of the actual inventory. Sales staff salaries, not at all related to the actual car itself. And once again, another selling expense. And then $140 for trimming shrubs. This is just going to be a general and admin expense, right? It's just general upkeep of the firm. So you'll notice all three of those simply get put down here, and they will be expensed as incurred. And you say, well, why does this even matter? Who cares? Well, I'm going to draw out our quick picture for us, right? So if we were to remember, we had some type of picture like this that we looked at last time. And we said that what we saw was that we would start with beginning inventory. We would add in purchases. So we had beginning inventory plus purchases. That gave us something that we called cost of goods available for sale. And then we said that splits out into two pieces. And we've either sold the thing, and if we've sold it, it goes to cost of goods sold on the income statement. Or if we haven't sold the thing, it stays in ending inventory on the balance sheet. And we said this was going to be a very powerful tool for us, not only back in chapter 4, but especially here in chapter 5. And we may see some limited use for this again outside of the second exam. But the big idea here is that what we're saying is this $20,960 is sitting on the balance sheet right now until it gets sold. Whereas this $1,280, essentially, right, this is an expense, and this goes straight through to the income statement, not through cost of goods sold, right? It's not actually related to the good. This is separate. But then whenever we actually sell the vehicle, this full $20,960 that was sitting in ending inventory will then be moved over to cost of goods sold on the income statement. And so that is what we are seeing. That is why this is so important, is that if I misallocate the amount here and I go ahead and start expensing stuff that should have been capitalized, then I'm going to overstate my expenses in the current period, understating income, and then see the reverse effect in the next period. But if we get this right, we accurately state income in the first period, we accurately state assets in the first period, and then we can accurately state income and assets in the second period. So that is why this is so important. It can have a very significant impact as we move across periods. So that handles question number 2. Number 3. So here in number 3, we're told Watan Company reports beginning inventory of 20 units at $44 a piece. Every week for 4 weeks, it purchases an additional 20 units at respective costs of $45, $46, $49, and $54 per unit for weeks 1 through 4. Compute the cost of goods available for sale and the units available for sale for this 4-week period, assuming no sales occur during these 4 weeks. So I'm going to see if I can get that picture back. There we go. We don't have to redraw it. So we'll just clean this up a little bit. But this gets us back that initial picture that we wanted. Okay. So basically what they're asking us for here, just to kind of orient ourselves, remember they said compute the cost of goods available for sale. That's right here. And the units available for sale for the 4-week period. So a really important point is that this graph right here, or this picture, whatever you want to think of it as, works both for dollars, which is important, and in terms of units. So if you can remember that, then however I ask you a question, you can figure out what you need to do. So let's go ahead and start. So in this case, they tell us, right, every week for 4 weeks, we purchase 20 units. So that's where these 20 units come from at respective costs of $45, $46, $49, and $54 for weeks 1 through 4. Well, actually, I'm sorry, I messed up my arrow just a tad. All right, we already had 20 units. The 20 units per week is for these 4 units right here, right? These 4 rows right there. So they want us to compute the cost of goods available for sale and all of that. So basically what we're doing is they told us we had beginning inventory 20 units at 44. So that's this first piece right here. 20 times 44 is 880. And then we just come on down the line because we know that every week we bought 20 more units and they gave us the prices. I can then simply pull in those prices right here and then simply multiply across all the way down. And when I do that, I will come out to these numbers here respectively, and then simply totaling those up will give me my cost of goods available for sale in dollars. And then over here, just coming down the line in units, I'll have my actual units available for sale. So you'll notice slightly different terminology, right? In this case, it's not cost of goods available for sale anymore. It's just units available for sale. And basically what this is telling me is if I were to fill this out in my picture, what that would be is that if I were doing this for units, I would have 20 units in beginning inventory. I then purchased 80 units, and that would give me 100 units available for sale, which is what we have right there. And if I were to do this for the dollar piece, then I would find that I had $880 here. We purchased, I believe, if you add all of this up, it's $3,880. Now, I didn't do that with a calculator. I'm just looking, I think that's right. So if that's not quite right, then you can check it. It's just adding those 4 up. And then whenever you add these 2 together, you would come out to the 4,760. And so this works. And that's the key takeaway here. This works not just for dollars, but also for units. So very important takeaway there. Very important. So with that, we have wrapped up number 3. Now here in number 4, we start to get kind of to the meat of chapter 5. So here in chapter 5, there are a couple of key topics, a couple of key items that we need to be careful of. And one of those is this idea of FIFO, right? So we talk in class and we talked a lot in the lecture about what FIFO means and how it works. But just quickly remember, FIFO tells us this is first in, first out. That is the information that is being conveyed when I'm looking at FIFO information, right? So whichever inventory units the company got first, those are the ones that we are assuming are sold first. So the key here is to remember, right? These pieces or these costing methodologies that we're looking at here in chapter 5 do not, right? So the cost method chosen, so think FIFO, LIFO, etc., right? The cost method chosen does not have to match the actual flow of goods. And this is a really important thing because it tells us that essentially we get to just kind of decide how we want to do this, right? So if you think about it, Walmart may decide to cost their, say, bread using a FIFO method, right? Just for a basic example, I think we can all kind of imagine Walmart or Kroger or whoever your favorite grocery store is kind of deciding how they're going to cost their perishable goods like their bread. And they may say, well, we would really like this to be FIFO, so we're going to treat it as FIFO, right? First in, first out. But from a customer perspective, first in would mean you would be buying the oldest bread. So you would walk in, look for the bread that expires in 2 days and buy that loaf. Now, is that the way customers typically behave? Well, no. What we find is that people will kind of move the bread around and look for the bread that's got the longest date from the time of purchase, right? So that has the longest amount of time left to still be good. So what we actually find is that the buying pattern of the bread in this instance is more like a LIFO, right? Last in, first out, right? You want the freshest bread, not the bread that's about to be stale. But Walmart would still be allowed if they wanted, and I'm not sure if they do use FIFO or not, I haven't looked, but they could use FIFO, even though from our just brief example here, we can tell that's probably not what the buying pattern actually is, right? It is far more likely that people are actually buying that up under LIFO rather than FIFO. So kind of an important thing to figure out there and not to get hung up on. The other important thing to look at is just some of the general conclusions, I guess we could say, that can be drawn from looking at FIFO and LIFO. So I'm going to try to make this look decently nice. So let's see here. Need us a couple of areas on this table. And you've seen this table before if you've watched the other videos. So we're going to get us 3 columns here. And that should do us. 1, 2, yep, that should work. So in this case, what we're looking at is kind of the financial statement items in this column. We'll look at FIFO in this column. So we'll do FIFO like this, and we'll do LIFO like this. And in truth, I probably made this table a fair bit larger than it needed to be. But this is kind of what I'm wanting to emphasize. So if we come down the income statement and we're comparing between these two, we see cost of goods sold here. We see gross profit. Eventually, bottom line on the income statement is net income. And then, of course, we still need to consider the balance sheet impact. So let's look at ending inventory. So this EI at the very bottom is ending inventory. And we note these top 3 income statement items. This very last one is the balance sheet impact of choosing a different method, either FIFO or LIFO. And there is one important caveat to this, right? This graph right here only works, right? Or this table right here only works in this following case, that we actually have something like this, where we have time marching on. So our x-axis here is time. And then here, I'm just going to put a $sign, but this is price level, right? This is the average price level. So what this is telling me is that prices are increasing over time, or what we call an inflationary environment. This is by far the common case, at least in the United States. The alternative to this is something like this, which is that prices are coming down over time. This is known as deflation. While deflation may sound nice, deflation is actually extremely painful for an economy. So luckily, we haven't experienced any deflation on a massive scale, but it is certainly something to be aware of, at least in these questions in class. I could certainly ask you, given a period of declining prices, and then you would just flip everything in this table. So it's very important that you understand that. So this table, the way that I'm drawing it is assuming the normal case of rising prices. I don't think it's worth memorizing the table both ways. Learn it one way, and then if I happen to ask you for the other direction, you just flip everything, okay? So with FIFO, what we're saying is in this price situation, first in, first out means these are the items right here that I'm selling. If those are the items that I'm selling, you can see that relative to the later acquired goods, that price level or that cost is lower. So what I find is that cost of goods sold is lower under FIFO. And if we recall that my formula for gross profit is net sales minus cost of goods sold equals gross profit, and we just said that cost of goods sold is lower under FIFO, well, net sales hasn't changed. I'm subtracting a smaller number, which means that gross profit will actually be higher. Then I look at net income and I say, well, all right, well, how does net income get affected in all of this? So if we just come back into, let's see if we can come back straight into that text box. We might have to just add on to the bottom of it. But then what we would find is that we would just come in and we would subtract out our expenses, and then this would come down and give us net income. Now, true, this is a very abbreviated format, right? But it's just trying to make the point, right? We saw back in chapter 4, we actually have things like selling, general, and admin expenses. Then we come down to income from operations, and then we have all those other items, right? I'm not going into that level of detail here. Certainly, if you want to review that, hop back into chapter 4. I'll go through all of that there. But in this case, what we're concerned with is just the general flow of this. Well, if gross profit was higher and my other expenses aren't changing, then what that tells me is that net income under FIFO must also be higher. And if we pull back our other chart, I'm just going to kind of do the bottom piece of it here. But we had cost of goods available for sale here. Then we said that splits into its two pieces. One piece is cost of goods sold. One piece is ending inventory. And what we said was that these two added together had to always come back to cost of goods available for sale. So if this number, cost of goods sold, is lower, right? Imagine like a balance. So this side is lower. Well, then the only way for this to actually work out is for this side to get heavier. And so it pulls it back in line. So as cost of goods sold goes lower on this side, then what we find is that ending inventory on this side must go up. So for example, if this is 10 and cost of goods sold is 3 and ending inventory is 7, well, if cost of goods sold goes down to 2, then we know ending inventory must go up to 8. Or if cost of goods sold goes up to 7, then I know that ending inventory must come down to 3. And so that's what we're seeing here. So the end result is that FIFO also gives us a higher balance in ending inventory. And then, of course, we can just flip all of these arrows and we have the directions for LIFO. So out of these two, you look at this and you say, well, this looks wonderful. I understand why all of this is working the way that it is now. So now we can actually have a quick discussion on what this tells me and why might someone choose a LIFO. Because if I just look at this, I say, well, key takeaways here, right? FIFO in a period of rising prices gives, and we can see lower cost of goods sold, higher gross profit, higher net income, higher ending inventory. So what that's really telling me is my income statement looks better, right? Higher net income tends to be thought of as better. And my balance sheet looks better because my assets are valued more highly. And the reason this makes sense, if we look at our graph, right, just like we did at the beginning of this, is that under FIFO, first in, first out means these were sold, means these have not been sold. So last in is still here. So what we find is that looking at it, it appears that you should only ever use FIFO in a period of rising prices. But there is one reason, right, that companies may choose, instead of using FIFO, to actually use LIFO. So can you think what that reason might be? So I'll give you just a second to kind of think about what it might be. But if you think about it, I think you'll come to it. So at the end of the year, we have to file our income tax returns. So company will file their tax return. And essentially what happens is based on your net income, this is what we are paying taxes on, right? There's a lot of work that goes into exactly figuring out how all of this works, but a very oversimplified explanation is that we're just paying taxes essentially based on a percentage of our net income. Well, if under FIFO, I have a higher level of net income, then I'm paying a higher level of tax. So instead of doing that, I could opt for LIFO. It gives me the lower net income, which means I will pay less in taxes. So this is one reason a company may choose to use LIFO. The more, I guess, or the rather less cynical reason that a company may choose to use LIFO, though, is that LIFO tends to give a more current approximation of cost of goods sold. And it does a little bit better job of applying the matching principle, right? Because it says, well, okay, the last one's in or the first one's out. That's a lot more timely information, right? So it gets my cost of goods sold a little bit more accurate to current events. Whereas the FIFO method tells me that the inventory on the balance sheet is perhaps valued slightly more accurately because I've got these more current costs in inventory. So if you want to think about it in this way, then you could say FIFO, right? We're more worried about the balance sheet being accurate. So balance sheet. And then LIFO, we're more worried about the income statement being accurate. And that is perfectly fine, right? This is perhaps the less cynical way to view it. I believe this is a large part of the reason that we may choose LIFO. So you say, well, okay, let's think about it real quick. I come in, I say, well, I would really like to use LIFO for my income tax reporting, but whenever I talk to my shareholders, I think I'd really rather show them my financial statements prepared under FIFO. Can I do that? Right? My book accounting doesn't always have to match my tax accounting. That is true, but in this case, it does. This is something called the LIFO conformity rule. It is incredibly important that you understand this in this chapter because it pops up over and over and over again. The LIFO conformity rule simply tells me that if I use LIFO for income tax reporting, I notice must, right? Not I can, not I may, I must use LIFO for financial reporting also. So in other words, you can't eat your cake and have it too, right? So what we're saying is you can't turn around on the one hand and get the preferential tax treatment and then turn around on the other hand and say, look at my high net income to your shareholders. It's not how this works. You have to pick, right? You have to pick. Now, you can change between FIFO and LIFO over time. That is allowed, but essentially it's kind of difficult, right? You've got to have a pretty good reason for why you're making the switch. And if you keep changing your method for this very often, it starts to look pretty questionable. I do believe this is actually something that you have to get approved to be able to make this change. I'm not entirely clear on the process as I've never attempted to go through it, but I do know that it is kind of a big deal to start switching. So whenever you make this initial decision, FIFO, LIFO, weighted average, specific ID, whatever it is, whenever you first make that decision, make sure you're putting some thought into it so that you don't have to go through the hassle of actually changing it later. So in this case, very quickly then, now that we've kind of discussed how this works, it'll let us walk through the next several questions at a little bit quicker pace because hopefully we've established exactly what's going on here. So just as a quick reminder, I'm going to redraw our picture, right? So we've got our dollars here, we've got our time axis there. So let's just imagine what's happening. So we had beginning inventory on January the 1st. In that case, my inventory balance was just the 230 units at $2.10. Multiplying those two across gives us the 483. So that's my first line here. Now, the next line that we see, we purchased on January 9th, 50 units at $2.30. So that simply pulls in here. You'll notice this 230 at $2.10 simply pulls down, and then we add in the new information. Now, very quickly, we do need to scroll back up just a bit because they did tell us about a sale. So we'll go ahead and clear out some of that. And the sale that they told me about here was that we had, let me grab this. We sold 260 units on January the 26th. So what we've got to look at now is, well, are we to the 26th yet? And the answer, of course, is no. So that will come into play in just a moment. But for right now, we'll continue down. We'll then see that on the 25th, we purchased more units. So I, in fact, purchased 100 units at $2.44. Notice these first two are just a repeat from before, just coming straight down through the table. And then, of course, the new 100 units at $2.44. Now, the next thing that we've got to consider is on the 26th, they told us we sold 260 units. Under FIFO, that tells me first in, first out. So I simply follow the instructions. So first in, whatever the first inventory layer I had was, that is where my first sales are coming from. So in this case, I look and I say, well, okay, I had 230 here, so that entire layer will go away. So I'll take out 230. And I say, well, when I do that, I see that I've got 30 units that I still need to fill. So what do? I remember first in, first out. That takes me to the next layer. So now instead of having 50, I'll sell 30 of those. That will bring me down to 0. So my sale has been filled. And from that layer where I had 50, I subtracted 30. And that tells me that there are 20 units left. So what got sold? Well, I sold 230 at $2.10 right there. I sold 30 at $2.30, right? And that's what we saw here. That's where this piece comes from. Then we didn't sell any at 244, so we leave this blank. Then the question is, well, what is my actual ending inventory? Well, I had 50, I've got 20 left in this layer, so I've got 20 at $2.30. And of course, I didn't sell any of these. So that 100 at 244 simply pulls down into my table below. Now, there is a really important thing I want to point out to you here, and you may have noticed it, right? If you noticed it already, fantastic, right? You're extremely observant. Good work here. But what we're seeing is that if I come in and I look at this right here, this is effectively in our picture, cost of goods available for sale at that point in time. So as of January 25th, my cost of goods available for sale was $842. And we've established that that means that this will be split between cost of goods sold and ending inventory. So cost of goods sold in this case, 552. So 552. And inventory balance, 290. And if I add these two up, I do in fact come back to the 842. So it's going to be something extremely important as you work through the homework and as you work through the exam. Whenever you come across a question with a big table like this, anytime, right? Not some of the time, not occasionally, but anytime we make a sale, I want you to come back and check. Did my inventory balance plus my cost of goods sold on the row immediately after I just got this total back? If these two do not come back to that number, you have made a mistake, right? And it will help you catch that. It will help you catch that. Very good. And you'll also notice that if we were to do this with units, it would work as well. 230 plus 50 is 280, plus 100 is 380. Here we've got 260. Here we've got 120. 260 plus 120 is 380. Further emphasizing the point that you can use that table both for units and for dollars. Very good. Now, for the next one, we're looking at perpetual inventory costing with LIFO. So notice here, what we just did was perpetual inventory costing with FIFO. So that was first in, first out. Now we're going to work a very similar question, but using LIFO. So in this case, once again, go ahead and get your picture drawn if it helps you. We've got our price index here. We've got our time axis here. And we can see that over time, prices are increasing, right? Doesn't matter what the slope on that is. It's just the general idea that we're trying to see here. Just the general idea. So in this case, we see that we had beginning inventory, 320 at 310. So that'll simply drop straight in. Here it is. We then see, once again, the sale occurs on January 26th. So it'll be at the end again. And we had two purchases. Those two purchases simply drop straight in. All the way to this point, right? The numbers are different, but the process is identical between FIFO and LIFO because there has not been a sale. Right? The difference occurs when the sale happens. So what we need to look for now is, well, how many units did we sell? We sold 360. And we need to remember then, what method were we asked to apply? Well, in this case, the method I was asked to apply is LIFO, last in, first out. So my thing is, I need to sell 360 units. So let's go ahead and we'll switch over to the text. It's a little bit clearer. We've got our 360. Then I look, the last units that I got in were those that I purchased on January 25th. So I'll back out 100 units there. That will bring me down to a total of 260. Because that's not 0, I've got to keep going, right? My order has not been filled. So then I bump up a layer and I say, okay, well, I've used this entire layer. Now I've got to deal with this layer. So now I come in, I say, well, there's my 260. And that next layer up, we had 70 units available. And because I had 70 units available, then that tells me that I'm now at 190. Okay, so do you see how this is working, right? We're just pulling this all through. At this point, I'm still not at 0. So I say, okay, well, now where do I get my units from? Well, right here. That next layer up had 320. I'm going to need to take out 190 of those, and that will fill my sale. At this point, I have now done what the question asked me to do. So what I need to do then is just simply pull this information into my table. So I sold all 100 of these, so there are none left. I sold all 70 of these, so there are none left. I sold 190 of these, so there are in fact 130 left. So what I'll do, 100 times 340, 340. 70 times 330, 231. 190 times 310, 589, gives us 1160. And then of course, the only thing left was 130 at 310. So that simply drops in here. Now, as a quick check, right, I'm not going to actually show the math in this case, but if I were to take this 1160 plus that 403, that would be 1563. And if I were to take this 360 plus that 130, I would come out to 490, which is what we had here. So that's the way this works. And we can tell that we have done this correctly. Very good. Now, number 6 is kind of a breather question, right? We've done some hard work on the last 2. This one gives us a second to kind of relax and just have an easy conceptual type question. So in this case, better matches current costs with revenues. This is LIFO. This is what we said before. And the reason for that is, remember, we've got our dollars here. We've got our time axis here. And these are the ones we're selling under LIFO. Those are the more current items. As time has marched on, those are more current. So that puts current costs against revenue, right? Does a better job of following the matching principle. Okay. Now, the next one that we see, and let me get this back. Let's fix our axis. It's really sloppy. Okay. This one assigns the highest amount to cost of goods sold. And notice, right, this would not actually be enough information for you to answer the question. And if it did not tell you this, right, assume a period of increasing costs. Because if they don't say that, then what if the costs look like this and they're actually decreasing over time? Well, then it flips. So we've got to tell you what's going on with costs. So in this case, we're assuming costs are increasing. So that is the table that we looked at before, and that is telling me LIFO. LIFO will assign the highest amount to cost of goods sold in that case. Next, we see this tends to smooth out erratic change in cost. Oh, whoops, I'm sorry, I skipped one. 3 precisely matches the cost of items with the revenues they generate. This is specific identification. This is like if I'm selling houses or cars or boats or planes, right? If I'm selling something very expensive, it's got some type of ID number, some type of engraved identification, some type of marker so that I know exactly what is being sold, right? With a vehicle, there's a title. With a diamond, there's an engraved serial number on it. With a house, there's a whole lot of paperwork through a deed, right? With these types of things that are very expensive, we tend to have specific identification being used. Now, if I'm selling a tennis ball, right, and I've got 10 million tennis balls, other than knowing which type of tennis ball you bought, I don't really care that you bought tennis ball number 10,204 versus tennis ball 10,208 that are exactly the same, right? It makes no difference to me. Grab a tennis ball, pay for it, leave, right? That's it. So with that, it wouldn't make sense to use specific identification. But with something large, right, and expensive, we do want to know exactly what got sold, exactly what got sold. Number 4. Tends to smooth out erratic changes in cost. This is, of course, going to be weighted average. That is what an average does, right? It kind of levels the playing field. So instead of us having something like this, right, maybe we operate in an industry that's very reliant on, let's say, something like oil, right? Well, oil prices tend to jump around quite a bit. And so if we wanted to, we could use the weighted average method to get a smoother curve to help us better plan, right? To help us better plan and expect for things. It's a lot harder to run a business successfully when your costs are constantly bouncing all over the place. It's a little bit easier if you can kind of smooth that out. And so that's what the weighted average method is going to help us with. And we'll see how that works in just a minute. And then, of course, we've got inventory on the balance sheet approximating current cost. This is FIFO, and that's because under FIFO, first in, first out, those are sold, which means these are left. And if they are left, those are the units that are on the balance sheet. And you'll notice they have marched further in time. So these are more current items sitting on the balance sheet. So that is why that is the case. Now, that wraps up number 6. We'll go ahead and move on to number 7. So here we see we are using perpetual assigning costs with FIFO. This question is going to work extremely similarly to what we saw before. So if you want to, go ahead, take a picture of this up top as we go through this next piece, because I can't fit it all on the same screen. So go ahead and take a picture of this, and we'll kind of refer back to this information as we go all the way down. So I'm actually going to take a picture of this myself, just so I can refer to it as we go down the list. But truthfully, we can probably pull this information from the tables, but it doesn't hurt us to have it to actually look at either. So in this case, we come in and we see that Monson uses perpetual inventory system. Extremely important that we notice this is a perpetual inventory system. Here in chapter 5, remember, you are responsible for both perpetual and periodic inventory systems. In chapter 4, you were not responsible for periodic. So chapter 4, not responsible for periodic inventory system journal entries. I do not require that you learn those, right? At least not as of the time of this recording. If that changes, once again, I will be sure to mention that in class, right? If you're at all concerned, ask me and I will clear that up. But as of the time of this recording, in chapter 4, I am not making you learn the periodic inventory systems for those journal entries. But in chapter 5, you are responsible for the periodic inventory system cost allocation, which is what we're doing here, right? Figuring out, well, how much of this cost is on the income statement? How much of this cost is on the balance sheet, right? That piece in chapter 5, pretty small, not a lot of extra work is going to have to go into it for you to understand that. Versus in chapter 4, it's a whole nother set of journal entries with way more accounts. It's got a lot more complexity. It's a lot of additional work to learn that in chapter 4. So in this intro class, you're not required to learn the periodic entries, but you do need to know how to do these tables for periodic. But if you are an accounting major, right, if you are moving up, if you're even an accounting minor, it's certainly something you want to go through and read on your own, right? Go back to the appendix, read through those journal entries, read through how it works. And if you are at all confused, come by my office and I'll happily go through it with you, right? I will happily show you how it works. But for the vast majority of us who are not accounting majors in this class, it does not make sense to have you learn that information in this course, right? If you change your mind, certainly feel free. It'll either get taught to you in later courses or you can kind of pick it up on your own. But that's kind of what we're seeing here. So in this case, once again, we said it's going to be very similar to what we did before. So here we go. So we had beginning inventory of nothing. In this case, it looks like. Yeah, so we had no beginning inventory. So we actually had to purchase our first round of inventory. We did that here, 18 units at $4 a pop. So our inventory balance is $72. We then purchased 35 more units at $6 for an extra $210 in inventory. And so you'll notice the 72 and the 210 is the 282. And so this is essentially just pulling this down and adding in the new information. Now, on the 15th, it looks like we had our first sale. You'll notice once again, we are using FIFO. And here's the deal. This is perpetual FIFO. And truthfully, once we go through periodic FIFO, you'll find that with FIFO, it does not matter, right? With FIFO, you do not care if I ask you for perpetual or periodic, you will get the same answer every time because you still have to have something to sell. And FIFO is just selling the first thing first. So it cleans it up a lot. With LIFO, perpetual and periodic will typically give you different answers, right? They'll typically give you different answers. So here we go. Under FIFO, we see that we have to make the sale from the first units in first, and we can tell that we sold 28 units. So the first 18 come from here, so there are 0 left. And then the next 10 come from here. That means there are 25 of these left. So we've got the 18 at 4, the 10 at 6, that's the 132 right here. And then of course the 25 at 6 is the 150 right there. Coming down, We have one more purchase. 28 times 7 is 196. 25 times 6 is still 150. Plus the 196 is 346. And 346 plus 132 is our total cost of goods in this case. Now, one important thing I do want to point out just one more time, right? We've seen it before, but just to be clear, this 132 plus that 150 is that 282, right? That's not an accident. That's what has to happen. Also, the 18 plus the 35 is 53. 53 minus 28 is 25. And oh, look, there were 25 units here. So that will work every time. It has to. If it does not work, you have a mistake. Very good. Time to move on to LIFO. Once again, perpetual. Now, the reason this matters so much in this case is that LIFO perpetual, there's a key thing that I want you to remember. With LIFO perpetual, so with LIFO perpetual, dates matter, right? I cannot emphasize that enough. Dates matter, right? Under perpetual FIFO, I don't really care about dates, right? I mean, sure, I can pay attention to them, but it's not the end of the world if I kind of lapse and forget to pay attention to dates, because I'll get the same answer with periodic or perpetual. There's a little bit of leeway here. With LIFO, if you do not consider the dates, you will get the question wrong, right? Not you might, you will. Okay, you will get the question wrong. You must consider the dates. Okay, very good. So in this case, we're going to come on down and we're going to see that we have a lot of the same setup, right? A lot of the same setup here. All of this coming down, we still got the same 282 from before, but the difference is now, since we're using LIFO, when the sale occurs on December 15th. Well, on December 15th, the last inventory I have received on that day is this from December 14th, which means, and I'm going to roll up just to emphasize this, I cannot possibly sell on the 15th the inventory that I did not receive until the 21st. Does that make sense? Right? If I am doing this perpetual, what that tells me is that every time an inventory change happens, I'm updating immediately, which means I know which units I have in my possession and which ones I do not. So on the 15th, these units from the 21st, I didn't have. They did not exist in my inventory. Therefore, they could not be sold, right? They could not be sold. Very good. So we'll go ahead and pop on down. So in this case, what that tells me then is when I sold these 28 units, I'm looking at the last in, right? The last in was the purchase from the 14th. So 28 of those got sold. I've got 7 left. That means the 18 and the 7 come down to right there. The 28 simply bump over to here. 28 at 6 is 168. 18 at 4 and 7 at 6 is 114. And 168 plus 114 is my 282. So that does in fact work. Also 25 plus 28 is 53, which is what 18 plus 35 is. So we can see that everything is tying together very nicely for us. Very good. Now on the 21st, we come in, we purchase some additional stuff. So 28 at 7 is 196. Now my ending inventory, well, we look and we say, well, this part has not changed. There haven't been any more sales. So that simply bumps down. And then we just add in the new information. So at the end of the day, we come out for this period, 168 in cost of goods sold, 310 in ending inventory. Very good. So we'll go ahead, clear all of that out and continue down the page. So for the next one, we're looking at weighted average. Now, weighted average is a bit more involved than some of the others that we've seen up until this point. But not anything that we can't handle, certainly, right? We can certainly handle this. So let's go ahead and begin. Well, in this case, on December the 7th, we had 18 at 4, $72, 18 at 4, $72. So in truth, could you calculate an average at this point in time? Well, sure, but the average would just be $4, right? We've only got one layer of inventory. It was all at $4. So doesn't really make a lot of sense to actually compute a separate average here because of how simplistic it would be. So instead, we wait till the second row to actually compute an average. And we see here on the 14th of December, we bought 35 units at $6, which is $210. And so the question is, well, what is the average cost? So what you're going to do to get this, I'm going to come in and I'm going to take my total cost, $72 from the first piece, plus $210 from the second piece. That is $282. Then I will simply divide that by 53 units. And when I divide that by 53 units, right, so 282 divided by 53 units. So we'll actually clean this up a little bit just to make this nice and clear. That will give me my first average. This average is $5.32 per unit. So now you'll notice I do not have 18 units at $4, 35 units at $6 anymore. I now have 53 units at $5.32. That is what I have. So unlike FIFO or LIFO, I'm not selling specific units anymore, right? From a specific layer, I'm selling what I'm going to refer to as a composite unit or an average unit. It is made up of the cost structures of both of these. Now, just to be clear here, right? If you were to put this in the calculator and you got something like, say, $4.28, and you look at that and you go, okay, cool, I'm moving on. I want to caution you, right? I think you could tell before we did this, this was going to be closer to $6 than it was $4. And the reason I say that is look at how heavy this was. We only had 18 units at $4, but I had almost twice as many units at $35. So that tells me that this $6 piece should be pulling much harder on the average than the 4, right? That's why this is a weighted average, right? It's not an average. An average would just be $5, 6 plus 4 over 2, right? The average price that I paid across the two transactions, we could say is $5, but that is not what the weighted average is. The weighted average takes into account the number of units as well as the price for each of those units, right? So that is what we are seeing here. So before you even did this, hopefully you could look at this and say, I expect my average, I'm not exactly sure what it's going to be, but it should be greater than $5, right? This weighted average should be greater than 5 because I have much more on the side that is above 5, right? So if that makes sense, I hope that helps you out. If not, don't worry about it too much, but it gives you kind of a way to develop some intuition about kind of where this answer should be. Because I know a lot of times, especially on a test or something, when you're in a rush, it's very easy to type something in on the calculator wrong, and then you go with it because that's what the calculator said. But if you put it in wrong, it's going to give you wrong answers, right? Bad input, bad output. So having a little bit of intuition about where we expect this to maybe be is going to be kind of helpful to us. So in this case, we sold 28 units, and you'll notice now it's just at this price, 28 at 532, 148.96. And then 25 at 532 is $133. And if you actually do the math on this, the 148.96 plus the 133.00 is actually 281.96. So it's a rounding issue, right? Is why we're off here by a few cents. So if you wanted this to actually work out correctly, when you did this 282 divided by 53, what you would have had to use, right? And there's no way the homework's going to ask you for this many decimals, but you would have had to use 5.3207547169811. If you use that, right, and presumably that is still rounded, but if you used that, you would probably get this to tie out exactly, right? But that's all this is. It's a slight rounding issue, so we're going to ignore it for our sake, but that's what's happening here. And then finally, in the next piece, we had 28 units at 7 is 196. So you'll notice we had 25 at 532, 28 at 7. So once again, we had more of this weight. So I would expect the weighted average to lean closer to this than to that. And in fact, it does by just a little bit. And so we come out with a new average of 621. So of course, this was the 133 plus the 196 is 329. That divided by the 53 here is 621. And then of course, you can see cost of goods sold 148.96. And then our ending inventory is just this right here. Okay. So that is weighted average. So basically every time we have a new purchase, you will need to compute a new average. And then finally, the last question in this series is with specific identification. I'll go through it, but I'll go through it kind of quickly because specific ID tends to be the easiest one, right? It just tells me exactly what to do. So if you can follow instructions, you'll be perfectly fine with specific identification, right? They tell us here, we sold 28 units for $10 on December 15th. Of these, 14 are from December 7th, 14 are from December 14th. So in this sale, 14 came from here, gives me 4 left. 14 came from here, gives me 21 left. That 14 and that 20, or that 4 and that 21, sorry, 4 and 21 simply drop straight there. And then the pieces that were sold, the two 14s, come in right here. We know from our chart up top, that is the price on those days. It gives us the ability to calculate this right here. This right here, then simply pulls straight down, giving us the ability to see 56 plus 84 is 140. And then 16 plus 126 is 142. 140 plus 142 is 282. So that worked out nice and easy. And then of course, we just add in the new information here from the 21st, and that pulls down to give us an ending inventory balance of $338. Now, before we continue, I do want to take just a second to kind of review this. You'll notice that my perpetual LIFO, inventory 310, perpetual FIFO, inventory 346, cost of goods sold 132, cost of goods sold 168. So we saw exactly what we expected, right? This was a period of rising prices. And I don't think they told us that, but I can tell that by looking at my table. $4, $6, $7, prices are going up. So because of that, I would expect FIFO to give me lower cost of goods sold, higher ending inventory, and we do see that. I would also expect that my weighted average would be somewhere in the middle, right? Not necessarily 50%, it doesn't have to be exactly halfway in the middle, but it's somewhere between those two bounds established by FIFO and LIFO. And if you want to go back on your homework and kind of look it over, you'll find that that is true, right? Or at least it should be true if we've done this correctly. I believe we have. Specific ID is, whoops, I'm sorry, I was on specific ID and I was talking about weighted average, but this is our weighted average piece. With specific ID, you will likely find it somewhere in the middle because FIFO and LIFO should be the extremes, but some pretty interesting stuff can happen in really specific cases with specific ID. So I'm not going to say that there's a really hard and fast rule for it the same way as the other three, but the other three tie in nicely. Okay. Number 11. So here we see that we have some more perpetual costing stuff. So in this case, this will be exactly like the other questions that we worked up until this point. The only difference, and you can see it kind of right away, it jumps out at you, is we actually have multiple sales. So I'm not just having one sale in this case, I'm having several sales. And so we'll have to see how that works. But once again, I'm going to go through this kind of quickly. This video is starting to get pretty long. I don't want it to take up too much of your time. But the way this is going to work here is we just look down, and in specific ID, they told us somewhere exactly which units we sold. So notice for specific ID, we're told exactly which units were sold. That'll work just like the one we just finished, right? So we got beginning inventory, a couple of purchases. They told me exactly which units are sold. Those drop in here. And then my ending inventory is whatever did not get sold. So that's the first piece. Second piece, weighted average perpetual. So 225 at 15 was our beginning inventory. I then had a sale. Well, at that point, my average was 15. So 50 times 15 is 750. Then we purchased some stuff, 180 at 14. That means now my inventory layers, 50 at 180, or 50 at 15, 180 at 14, gives me 230 at a total cost of 3270. Dividing those two out gives me 1422. Coming down, January the 25th, this is 210 units. They got sold at 1422 is the cost, 2986 is that total cost. Then I've of course got 20 units left for 284.4. Once again, you'll notice off just a tad because of rounding. So if you wanted to actually work this out and get it to tie down exactly to the penny just for yourself, then keep some more decimals on these roundings, right? But otherwise, this is close enough for us. And then we bought an extra 350 units. So now we have 20 at 1422 from right here, plus the 350 at 1350 is this. Of course, in this case, it's going to lean much closer to the 1350 than this because, oh my gosh, look at how many units there are here, right? There are so many more units here and the prices are relatively similar. So it is going to shift dramatically toward the 1350. And we actually see that in the average, right? You can tell that 1422 price point was almost negligible, right? Because it only influenced this by 4 cents. So that's what we see happening there. Next, perpetual FIFO, 225 at 15. We then have our sale, of course, coming out of this 225. So 175 goes here, 50 stays here. We then purchased 180. The 180 comes in. 50 plus 180 is 230. So that's what we now have available. Here's my total cost. And just to point it out one more time, before we get too much further down, the 750 here plus the 2625 there does total back to this. And then as we come down, I've sold an additional 210 units. We remember this is FIFO. If this is FIFO, these are the ones I sell first. So those go to 0. Then I sell these. That goes to 20. So 50 here, 160 there. Here's this 2990. 20 then at 14 is 280. 280 plus 2990 is 3270. And then finally, we come down, we add in the last purchase. So 20 at 14 right here, coming down into the next layer, plus the 350 at 1350. 5,005 in total inventory, 5,615 in total cost of goods sold. So there's that one. And then number 4, perpetual LIFO. Once again, very similar to what we saw before. Perpetual LIFO, all the way down through this first sale is the same because I've only got one inventory layer. So I'm selling the exact same stuff as I was before. I then had a purchase, you'll notice, exactly the same as what we had under FIFO. And then on the 25th, when I make the sale though, this is last in, first out. So last in, first out. So the first ones I sell are these. So I sell all 180 of these. So those go to 0. I need to sell 30 more. So this goes down to 20. So I've got 30 at 15 is 450. 180 at 14 is this. There's 2970. And then of course, all I have for ending inventory is those 20 units. So 20 at 15 is 300. And once again, 300 plus 2970 comes back to that 3270. And then of course, we just add in the last purchase and there we have it. So that is our LIFO, FIFO, weighted average specific ID. And if you want to, this is a really good one to kind of flip back and forth between and look, right? Cost of goods sold. In this case, let's just look at what's happening with the prices. So price 15, 14, 13.50. So prices are actually declining in this case. And you'll notice that FIFO gave us cost of goods sold of 56.15, while LIFO gave us 55.95. Not a huge difference, but certainly interesting, right? Now that prices are declining, FIFO is giving us the higher cost and the lower ending inventory, right? So there it is. We'll also find that weighted average is somewhere in the middle. So 56.11 for cost of goods sold is between 56.15 and 55.95. And my inventory balance, 50.25 for LIFO and 50.05 for FIFO is of course the bounds around the $5,009 that we see for weighted average. So it works out pretty nicely in this case. Now, they just have you actually come down. I had forgotten they did this next. And they actually have you do what we just did, basically, and just kind of look through these. So what you'll do, you'll come in, you'll look for specific ID. In this case, they told us up top with the sales information, how much we sold these things for. So that's where this comes in, right? So if you do 175 times 24, that is 4,200, and 210 times 24 is 5,040. Plus 4,200 is 9,240. And that 9,240 is where they got the sales. And one very important thing you want to notice here is that it does not matter which inventory method you are using, sales is not affected, right? Customer doesn't care if you're pricing with specific ID on your end, if you're using weighted average, FIFO or LIFO, right? Have you ever walked into a store and said, hello, how are you pricing your bread today? And they say LIFO, and you just get so upset that you turn around and leave? Probably not, right? You probably never seen that happen. You probably won't ever see that happen because it just doesn't make sense, right? It's not something customers care about. So the way that we do this on our end should not affect sales. Now, there is one small caveat I would like to recognize here in that if I'm using this for my costing, right, and the differences are too dramatic, then it is possible that I could look at that and think my cost structure was something that it wasn't really, and then develop prices based on that cost structure and raise my prices, for example, to a point that was out of line with what I should have been charging. In that case, the market will probably be smart enough to go, okay, you're charging $8 for this. It should really be down to like $6 and people will buy less of it, which would impact my sales, right? But that's not an accounting issue, right? That's an economics issue. So we're not going to deal with that in here, right? That's what's called elasticity of demand. or specifically price elasticity of demand. So we're not going to deal with that in an accounting class, but it is certainly something that I do want to at least recognize that if you got this like really wonky situation where prices are just really crazy fluctuating over a short period of time, and you use different methods, I suppose it could lead to this situation where your pricing structure was out of step with what it should have been, but it's certainly something to consider. Okay, so it's certainly something to consider, just not in this class. Just not in this class. Then you'll notice cost of goods sold. This comes from all four of our tables up above. Gross profit is then just the difference. Our expenses, they told us somewhere, let's see, they might have given it to us down here. Yep, they gave it to us here. Assume expenses are $2,100. So that's where this row comes from. And the applicable income tax is 40%. So that gives us income tax or income before taxes. We then subtract out the income tax expense and that gives us net income. So exactly what we would expect. They then say, well, which method yields highest net income? Well, in this case, it's LIFO, which is contrary to that table we put up before. But remember, we said that table only worked if we had a period of rising prices like this. So we had dollars and time. In this case, what we have is something like this, where over time, prices are actually coming down, right? It's not getting asymptotic, right? It's kind of a bad drawing. But all this is really supposed to be is some type of curve downward, right? Prices are coming down in this case, which means that everything flips. Everything flips. So that is why LIFO is the answer here. Does net income using weighted average fall between? Of course it does, right? If the answer here is no, then it tells you you've made a mistake, right? So if your answer there you thought should have been no, then you've made a mistake somewhere. So go back and check that. If costs were rising instead of falling, then of course FIFO would yield the highest level of net income. And so that wraps up 10 through 12. I'm sorry, 11 and 12. Here we're looking at a couple of ratios. These are what I like to call essentially just plug and chug type ratios, right? If you know the ratio, if you know the formula, then it's just a matter of plugging in the information. So for this case, for inventory turnover, the formula for inventory turnover is simply cost of goods sold divided by average inventory. So they tell us here to compute inventory turnover for year 2. So inventory turnover for year 2 is going to be that 336,650, right? That cost of goods sold divided by the average inventory, which is the inventory from year 1 and year 2. So ending from year 1, remember, and this is kind of back to that idea that we talked about earlier in the class, ending inventory for year 1 is the exact same thing, right? Is the exact same thing as beginning inventory year 2. Year 2, all right? And so if we think about how we calculate average inventory, well, average inventory is beginning plus ending. And I'm going to bump this over just a tad so we can fit all of it. So beginning inventory plus ending inventory divided by 2. All right, so because I couldn't get this in like a traditional fraction, I do want to be careful with the parentheses here so that you don't think this is beginning inventory plus ending inventory divided by 2, right? You take the total of beginning plus ending and then divide that by 2. All right, that's the way that this will work. So because of that, we have established that ending inventory for year 1 is beginning inventory for year 2. So we can take this right here plus that right there, which is actually ending inventory for year 2, divide that by 2. That's where the 98,125 comes from. Then, of course, inventory. My days sales in inventory. Oops. Let's see. All right, I think we're recording, okay. I got an error that popped up on my computer that said that the recording had been stopped or that the mic. I'm not sure exactly what is causing that, but now it appears to have messed up again. Let's see. Okay, I think we're good. So hopefully the camera will stay working the way that it's supposed to. So in this case, then days sales and inventory is simply ending inventory over cost of goods sold times 365. So ending inventory divided by cost of goods sold times 365. And of course, the exact same thing here. Now, one important thing I do want to mention is anytime you see days in a formula, what I want you to think is multiply by 365 every time. All right, at the end, if you see days, sales, and inventory, days, sales, and accounts receivable, days, anything like that, at the end, you multiply by 365. If you do not, you will not get the right answer. Okay, very good. So that's 13. 14, periodic. So you can tell we spent a lot of time in this video dealing with perpetual. Now we're going to touch on periodic here toward the end. So what we find is, if you want to take a quick picture of this, feel free. And that should work out just fine for you. But basically what's happening here is we have Monson. They sell 28 units for $50 each on December 15th. Assume the periodic inventory system is used. Determine the cost assigned to 12/31 when costs are assigned based on FIFO. The good news is that this opens up a shortcut for us with perpetual, in that perpetual FIFO, so perpetual FIFO and periodic FIFO will always be equal. They will always give you the same answer. And periodic is much quicker. Periodic is much, much quicker than doing perpetual. Now, this is only true, once again, for FIFO. If you try to take this shortcut for LIFO, it is very likely you will get the wrong answer. So here we go. In this case, we had some purchases. We had 3 purchases here totaling up to this amount. We had a couple of sales totaling up to this amount. I simply say, well, I'll sell the first 28. So I start at the top. This goes to 0. Start at the top. And this goes down to 22. And so then at the end, I've got 22 and 28, and that's it. That's how this works, right? I don't really care about dates anymore, because in this case, what they told me was that we had a sale, right? And specifically 2 sales. But I truthfully don't even care on the date that happened, because under periodic, I just update inventory at the end of the period. So I don't even really need to know, well, all right, what if I had a sale happen right here on December the 8th, right? It doesn't matter, because I'm still selling the first units in. So nothing would really change regardless of when things happened under FIFO, which is nice, which makes FIFO pretty quick, because then, like, if I look at this just straight from the beginning, I can see here we had these purchases, blah, 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 blah. And I can see that we had these sales. Without even doing this table, I can look at that and probably tell you within 5 to 10 seconds what these numbers are going to be. Because I can simply start at the top if I want cost of goods sold and count down. And then that tells me the cost of goods sold. If I want ending inventory, I simply start at the bottom and go up until I run out of stuff, right? And so it works out really, really nicely. And like I say, it may be a bit confusing in this video, but I'll certainly show you that shortcut in class. If I don't offer to show it to y'all, just make sure you ask me and I'll go through it. Some semesters I don't go through it if we're running out of time, but I do try to show you all the shortcut here because sometimes it can just get really tedious making those really big tables. And for FIFO, it's not really necessary. It's not really necessary. So very good. Now, periodic inventory costing with LIFO, absolutely necessary to make the table. Absolutely necessary to pay attention to dates. Dates absolutely matter. Because what this tells me is now, if I have a sale, say here, let's just say I have a sale on December 11th. Under periodic LIFO, remember, I'm only making this entry at the end of the period. So I can actually sell something that I did not get until the 21st in this sale on the 11th. It's kind of a mind-blowing thing. I get it, right? But that's what we're saying, right? We're only updating this at the end of the period. So I can use anything I had at any point in the period. So it really changes this around some. So in this case, total units, all of this section here, notice exactly the same as before. But now, even though my sales happened earlier in the period, notice, right? We sold this on December the 15th. That's when the actual sale happened. But the units I'm selling are the units from the 21st. And that's because under periodic, I only update my records at the end of the period. So I can do things that don't make sense time-wise, right? There I say, well, I can't sell something on the 15th I didn't have till the 21st. but under a periodic system, you can, because we're not making this entry until, let's say, December 31st, right? Until December 31st. That's when the entry is being made. By that point, you certainly do have this stuff from the 21st. So that is why this works. That is why this works, and that is why we see this difference. Very good. Now, number 16, periodic with weighted average. This is nice because we get to just calculate one weighted average, right? Boom, done. So we come in, we figure out all of our stuff that was available for sale. We can then figure out our average cost, so 23.28. So if we do that real quick, divided by 78 units, that is $29.85. That's where this comes from right here. We sold 28 units at that cost. That's that amount. And then my inventory value is just the difference between these two. And then, of course, we had 78 minus 28 is 50 units left. And we can then see very clearly that my cost of goods sold is just the 28 times the 29.85 for the 836. And finally, specific ID with periodic is exactly like perpetual periodic, right? In either case, I know exactly which units got sold. So we're just going to follow the instructions here like we did before. Setting up initially my total cost of goods available for sale. And then I can tell, well, okay, we sold 14 from December 7th, 14 from December 14th. So on December 7th, 14 of these got sold. So this goes down to 4. And 14 of these got sold. That goes down to 18. So then we can see there's the 4 coming over. Whoops, right there. There's the 18 coming over right there. And of course, the 28 flows straight through. So when we go back through this, we see very easily then that what I've got is 14 and 14, which is the 28 units that were sold. Gives me cost of goods sold to 700. Then I've, of course, got the 50 units left for 1628. In ending inventory. And with that, we have officially wrapped up our chapter 5 discussion on inventory. So if you do have any questions, please feel free to let me know. I'd be happy to sit down and look at it with you to help you understand it. But hopefully you find this video helpful. So if you do have any questions, once again, always feel free to let me know. Otherwise, we'll see you next time. Thank you.